Hello everyone, welcome back to our channel and welcome back to this video. This video is a part of our Capital Insight series for the Punjab Capital Research. In this video, we're going to focus on the quantitative investment strategies and tell you about the Quant Conveyor. And this is about how 850 billion in bank-run systematic strategies are rewiring the institutional allocation playbook. Let's start with a bit of a context. The quantitative investment strategies run by the bulge-bracket banks have scaled from roughly 362 billion to 850 billion in notional exposure over 5 years, with leverage pushing the deployed capital above $1 trillion. The client base is no longer confined to the hedge funds, pension funds, foundations, endowments, family offices, and private wealth channels are the incremental buyers. The shift is being driven by three forces: an eroding conviction in fundamental managers in an AI-accelerated market, a volatility regime that rewards rules-based execution, and bank economics that make quantitative investment strategies one of the most capital-efficient revenue lines on the street. However, the risk, that is overcrowding, reflexive front-running by the hedge funds, and factor concentration inside allocator books are still real, but they sit outside most standard risk dashboards. With this background, let's do a deep dive and let's try and understand the issue. Now, there's a quiet migration that is happening across institutional balance sheets that is not showing up in the usual allocation dashboards. The endowments, foundations, and family offices that spent the last decade writing checks to hedge funds are now writing them to bank trading desks instead. And the product that they are buying is not fundamental discretion. It's a rules-based systematic strategy packed as a derivative contract delivered off a menu and priced like a utility. This is the story of the quantitative investment strategy complex and why it is one of the most fastest growing businesses on Wall Street today. As always, let's start with the numbers. Start with the scale. The bank quantitative investment strategy platforms globally hold around 850 billion in notional exposure today. 5 years ago, that figure was closer to 362 billion. This is better than doubling. And once you apply the leverage embedded in the underlying total return swap structures, the deployed capital clears $1 trillion. This is large enough to move markets, not merely to participate in them. JP Morgan alone runs more than 100 billion in notional QIS exposure. The firm's QIS revenue line has grown 30% so far in 2026 versus the same stretch of 2025. An acceleration from roughly 25% annual growth in the prior years. Goldman Sachs Asset Management holds around 175 billion in QIS funds, about 5% of the total assets under management. Morgan Stanley and Citi are expanding competing platforms, and this is not a niche product line. It is a structural pillar of the modern markets business. But what we also need to understand is, why are the allocators moving now? There are three forces that are pulling allocators into this complex, and they reinforce each other. First and foremost, the fundamental edge is decaying. Secondly, the passive concentration is a problem. And thirdly, volatility is also persistent. Let's start with the first force, which is fundamental edge is decaying. The market speed has changed and information is priced faster than a traditional fundamental process can adapt. And allocators are losing conviction that discretionary managers can consistently deliver alpha in an AI-driven tape. And when we are talking about the second force, which is passive concentration being a problem, there is a decade of flows into passive indexing that has quietly handed a handful of mega-cap technology names an oversized weight in every 60-40 portfolio on the planet. Allocators who want to reintroduce genuine active exposure without hiring a discretionary manager are turning to systematic overlays as a third path. Trend, carry, volatility selling, cross-asset momentum, equity protection. These are factor exposures that are difficult to replicate through conventional mutual fund or ETF wrappers. And this brings us to the third force, which is volatility being persistent. The tariff policy, Fed path uncertainty, and unresolved geopolitical risk have kept realized volatility elevated across all the asset classes. The quantitative investment strategies programs can be configured to systematically buy downside protection on a schedule rather than reacting to the drawdowns after the fact. And that's why, for an institutional committee that is tired of the scramble, a rules-based hedge program is governance-friendly. It converts portfolio insurance from judgmental call to policy. Next, let's talk about the mechanics out here. Operationally, a QIS trade is almost always a total return swap between the investor and the bank. The investor picks up a strategy from a published menu, the bank implements the underlying trades and delivers the net return through the swap. There is no fund structure to set up. There is no separately managed account to fund. The capital commitment is defined, the rules are preset, and the execution risk sits with the bank. Some of the newer strategies are also interesting. A few banks now offer programs that run language models against earnings call transcripts in real time and rebalance cross-sectional equity exposure within hours. Others offer automated put spread callers that rebalance on a fixed calendar. Wealth channels lean into systematic tax losses harvesting inside direct indexing wrappers. The menu has widened considerably, and it's the breadth of the menu that is drawing in the mid-tier institutional clients. Which brings us to the next important segment, which is why do banks love this business? The bank economics are worth understanding because they explain why the push into retail and mid-tier institutional is so aggressive. The QIS revenue is structurally capital light because the trades are preset, the capital charge against them is lower than it would have been for equivalent discretionary market making. The margin profile is attractive. Banks earn a structuring fee, a bid-offer spread on the underlying execution, and often a running fee on the notional. The revenue is reasonably predictable, and the human cost base is low. So essentially, what can be said is that portfolio managers cost money and take bonuses. Computers do neither of the things. So for a markets franchise looking for the revenue that is not exposed to balance sheet incentive financing or principal risk, QIS is close to ideal, and that is why it has become one of the fastest growing lines at largest dealers. However, we also need to talk about the risks that no one is pricing and why the institutional allocator needs to slow down. First and foremost is crowding. When the same rules-based strategies are being sold to thousands of clients, the underlying positioning converges. That is mechanical. And when the positioning converges, the expected return from any given strategy compresses. This is the first order risk that allocators underestimate. Past performance was generated when the strategy was narrowly held. Future performance will be generated in a more crowded pool. Secondly, there is a predictable flow problem. Because QIS programs rebalance on preset schedules, their flow is forecastable. Discretionary hedge funds have begun building strategies specifically designed to anticipate those rebalances and trade ahead of them. So now this is becoming more of a cat and mouse dynamic that can amplify moves in thin markets and can introduce reflexivity that was not present when the same flow sat inside proprietary trading books. Recent anomalous moves in certain volatility and carry markets are consistent with this interpretation. And then there is the hidden factor concentration. An allocator that runs discretionary hedge funds alongside bank QIS programs can run up doubly long for the same factor exposures without really realizing it. A systematic volatility selling program inside a QIS book can mirror exposures already present in a multi-strategy hedge fund allocation. Without a factor decomposition layer, the concentration sits invisible in the portfolio until a regime change exposes it. In closing, we can say that the institutional lesson from the last 3 years of private credit expansion applies here as well. When a capital-light, high-margin product line scales rapidly, supply of new strategies eventually meets broader investment demand. The winners in that cycle are not the allocators who got in the earliest. They are the allocators who built in frameworks to evaluate strategy capacity, factor concentration, and structural flow risk before those issues showed up on drawdown report. The Quant Conveyor is now running full speed. The question for every institutional investor watching this build is whether their governance process is equipped to evaluate what is actually inside the wrapper. That's it for this issue of Capital Insights from Punjab Capital Research. Thanks for watching. Hope you have found this video insightful. Stay tuned in for our next edition.